Our next guest sees a high-risk market environment for the next 10 days. Stuart Kaiser, Citi's head of equity trading strategy, joins us here on set. Stu, great to have you with us. Obviously, the election is a big part of that. So how are investors positioning themselves?
Yeah, look, I think the last couple of weeks we've definitely seen investors lightening up on some risk kind of going into the election. Not just the election, as we talked about, FOMC, payrolls, et cetera. But yeah, I think it's considered a big enough event. I know odds and polling moved in one direction the last couple of weeks, but our view is this is basically a 50-50 event. And for that reason, I think you are seeing people kind of take down risk a bit. If you look at put skew on the S&P has risen, the price of call options on the VIX has risen. So you are seeing people either reducing position or overlaying some hedges with the big event, calendar ahead of us.
The risk is not necessarily who wins or who loses. The risk is not knowing. Is that right?
Yeah, I think the risk is not knowing. And, I think generally speaking, if you talk to investors, they'd like to avoid a sweep scenario. I think, both candidates have some policies that the market doesn't love. And if you get a split government, I think that's where, most people kind of want to end up at this point.
So we had the conversation. Tim thinks yields are going higher because I think it's a combination. But, where do you come down on this higher? I mean, they moved 60 basis points in the 10 years from the low to where we are now. I think they continue to go higher. Market doesn't seem to care right now.
Yeah, the market doesn't care. I'd say it's probably 70% of the move is, I would say, coming from the growth data and maybe an ancillary part from the election. But again, intelligent people have got to disagree on what that is. And that's why markets don't care. I mean, our view on yields for the last couple of years, it's the why that matters. And I think we saw that for 18 months before July, which is if you get strong economic data, positive growth surprise, rate cuts get pushed out, this rolling recession risk gets rolled into the future. Again, equities are fine in that environment. And I think that's why you're seeing the performance we are.
So it's actually a pretty benign environment, in your view, after 10 days from now.
Yeah, look, if it wasn't for the election, I think you'd look at the payrolls report, the GDP numbers. Inflation, I know, was an upside surprise the last couple months, but frankly, the Fed would tell you we're on a gradually, slowing trend on that side of things. So yeah, I think if it wasn't for the election, you'd probably have risk to put on. If the election resolves itself in a relatively orderly fashion, and that might be a big if, as Steve said before, but I think there is risk to be added, and the macro backdrop is supportive of that. So it's a good setup into year end once we get past the election.
Stuart, let's talk about positioning then. What's fascinating to me is, first of all, that financials have probably one of their largest overweights in a long time, and they're breaking out. But I would go back even just to tech. It seems to me one of your competitors out there saying underweight is the widest levels in 5 years at minus 4.3, driven by a lot of below benchmark positions in semis and hardware. That seems extraordinary to me, and the fact the market's doing what it's doing. So comment either on the positioning, or is this great news for the markets?
I would agree with the sentiment. I'm not sure if they're underweight, but definitely I think the sentiment on tech, or the bar for tech, is lower this quarter than it probably has been in at least a year. We're definitely seeing renewed interest, I think, in the software and internet side of things at the expense of kind of hardwares and semis. So the way you describe that data is, I think, how we're feeling flows go through the system. And look, that's a positive. If you remember last quarter, you had NVIDIA put up $30 billion on 75% revenues, and that was 75% margins. That was considered a miss, right? So I do think the bar is set a little lower this time, and I think that's healthy, going into earnings.
We were talking with Steve about probabilities of Fed cuts. Does that, obviously it matters, but does it really matter if it's 25 now, 25 later, pause now, 25, I mean, in the grand scheme of things?
In the grand scheme of things, it might not.
6 months.
In the grand scheme of things, it might not. But next week, it definitely will matter. So, look, would the Fed take back 50? I think in their view, they probably wouldn't. Their view, I think, is they are very restrictive to begin with. They are convinced inflation is trending the way they want it to, and I think they want to gradually get themselves back to neutral. And there's no way they're going to admit they made a mistake either way. But yeah, so I think, look, a 25 basis point, cut here or there, I don't think is as big an issue. I think to Steve's point, it's the cumulative number of cuts that are priced in over an extended period of time. But look, the market's expecting 25 next week. Market's probably going to get 25 next week unless something really outlandish happens in the labor market data. And look, this labor market print's tricky. Our economists are only at 90K. You've got strike impact. You've got weather impact. Right. You had a very low response rate to the last payrolls report. So that 254 from last month is going to get maybe not as much attention, but a significant amount of attention as well this time.
So volatility.
Yeah, definitely.